Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the big market moves that US megacap tech stocks have been making and whether those moves can continue. My guest is Satya Pradhuman, who is CEO and Director of Research at Cirrus Research. Well, if you ever needed market moves to illustrate exactly what this discussion is about, just look at the reaction that followed the US debt ceiling deal. Coupled with signs of slowing wage pressures and hopes the Federal Reserve can pause its rate hikes, it pushed the S&P 500 and the Nasdaq to their highest closes since August 2022, with big tech leading the way up. And leading big tech has been Nvidia, its stellar rise coming, of course, on forecasts of big AI-related revenues still ahead. And with that rise pushing Nvidia, for a time at least, into an elite group of companies worth $1 trillion or more. So is this the moment for an investor to bulk up on big tech, or should they cash in on any gains? Well, joining me now is Satya Pradhuman, Director of Research at Cirrus Research. Satya, welcome to Sectors Up Close. I think we have to begin with one word, which is Nvidia, up around 170% year to date, and at one point with a forward price earnings ratio of 60. Is it worth it?
That's right. That's right. I think for the individual investor, this is a time to be very cautious. You've got a very tactical trending market that's underway. I do think this is a place for professionals. Our fundamental work suggests that the spending on AI, ChatGPT, all of those wonders, they're here. But the question is this a new shiny object we're all chasing? And I think we should learn a little bit from history that blockchain is a phenomenal technology and is probably went a little past where the markets saw it. And so to some degree, these are cycles that seem to repeat themselves. But the reality is that we had this wonderful interest rate relief moment when the Fed hinted that things are going to be, they'll wait and watch. And to some degree, this is what's allowing really expensive stocks to take on a higher and higher level.
So I believe that your overall thesis is that these extreme moves will in fact continue. Will they take investors into a good place or a bad place? Are we looking possibly at bubble territory later down the line?
There are signs that says if we've got this interest rate benefit relief moment that lasts 6-9 months, these stocks could easily climb a lot higher. So the one thing we're watching underneath the signal is really the fundamentals of the moment. And the reality is that CapEx technology consumption data is slowing. It is materially slowing. If I'm a perma bull in tech, I'd want to say that's great because they're going to have better margins. However, what is a business owner doing and what are they signaling when they fire their people? They're telling you they're worried about where revenues are 12 and 18 months out.
Well, there appears to be some concern over the broader market rally as well. Just to quote some figures, just 7 stocks account for all of the S&P 500's returns this year, and on an equal weight basis, the S&P 500 would in fact be down. So is it sustainable?
We're all crowded into these very few names. We've got some tactical models. We're monitoring this. And what it seems to us is that, believe it or not, based on some of our measures, things could get more extreme before they trigger, let's say, a sell rating from our models. So I do think it is a nervous moment. And if you look back the last 3-4 years, we have plenty of examples of where, AMC and the next player and the next player, we all chased after.
Now, you mentioned slowing CapEx being a bit of an issue there. You've also mentioned the Fed. What are the other factors that investors, if they are brave enough to go into this space, that they should be looking at?
To some degree, the active manager that's very stock specific has a chance to add a lot of value here. At the same time, from a macro standpoint, clearly if the CapEx data settles and the US economy isn't as weak as we think, there may be some stability here. The irony, though, is that you almost need a recession for the Fed to begin to cut interest rates, which would support these high multiples. So that's what I fear is the conundrum for investors right now.
So if you had to put your money on this rally running out of steam, first of all, is that going to happen? And if so, by when, do you think?
Very difficult question. Plenty of disclaimers I can put out there. But to give it my best view is I think you've got another 6-9 months of whatever's going on here to run its course. And why do I say 6 or 9 months? I think this is the amount of time that we either go into a recession, get interest rate support, and therefore these stocks continue, or in 6 or 9 months, we realize the US economy is actually more stable. There's no interest rate relief, and heaven forbid the inflation bogey comes back. Highest multiple stocks get punished in that. We just lived through that the last 18 months. No reason why that can't occur again.
Okay, Satya, it's been a pleasure to hear your thoughts today. Satya Pradhuman, Director of Research at Cirrus Research. Thank you for being with us. And that is your look at investing in US megacap tech stocks. I'm David Pollard, and this is Reuters.